Today we will learn about the basics of cash basis and accrual basis accounting systems. To see the difference between cash accounting and accrual accounting, I'm going to go through this little example. And first I'm going to account for things using a cash basis of accounting. And then we'll do it with an accrual basis. And just so you have some context, the cash basis is anytime you get cash from a customer, you would count that as revenue. And anytime you have to spend cash, you count that as an expense. And you'll see that that's what most small businesses do, while most slightly more sophisticated businesses would use accrual-based accounting, because that matches up your actual expenses and your revenue a little bit better in each period. So let's just go through this example, using the cash basis first. And we're going to assume that we start off with no money. Let's assume that you started a catering business. So in first month you cater an event, and the customer pays you $1,200 that cost you $500. In the second month you cater another event for a customer who agrees to pay you next month. This time the event costs you $500. In the month 3 you receive the $1,700 for last month work, plus you also receive an advance payment of $300 for next month work. In the month 4 you cater the event for $150 cost. Before we solve this example, let's prepare a format for both cash basis and accrual basis. So in month 1, you cater an event where the cost to you was $500. The customer pays you $1,200 for your services. And maybe they pay your $1,200 ahead of time, so that you have the cash to go buy the food, and the paper cups and paper plates or whatever. So you get $1,200 in revenue. This is a cash basis of accounting. And you get to spend $500 of that on supplies, and maybe you had to hire some help, and you had to pay yourself a salary. So if you got $1,200, and you used $500 of that, your profit here is $700. And if you started with no cash, your cash at the end of period, this is going to be the cash at the end of month 1, you will now have $700 of CA. Now let's go to month 2. You cater an event where the cost to you was $800. You and the customer agree that they can pay you $1,700 the next month. So in this month, we have to use $800, maybe our bank lets us overdraft. This is an expense, so we are going to use $800, but we don't get any revenue because we're doing the cash basis accounting. The customer's not paying us in that month. They're paying us $1,700 the next month. So we get no revenue in that period. So it looks like we got no revenue. We had $800 of expenses. Our profit here is going to be negative $800. And when we look at how much cash, we had $700 of cash entering into month 2. We're using $800 of that. And so now we've kind of overdrawn our bank balance. Maybe we owe our bank now $100. Let's go to month 3. You get $1,700 from the customer in the previous month. You also get $300 in advance from a customer that you have to cater for next month. That is the month 4. So we've done no catering in month 3, but we've got a lot of money. We got $1,700 from the previous month's customer and $300 for a customer that you're going to cater for next month. So we got $2,000 on a cash basis in revenue. And we had no expenses that month. So we have $2,000 in profit, and our cash balance increases by $2,000. So at the end of this month, we now have $1,900. That is $2,000 minus $100 that we owed to bank from month 2. Now month 4, you cater the last customer's event. It cost you $150. So once again, you just had to spend the $150 in month 4 to cater the actual event, but you got no revenue in that month. So it looks like you took a loss, negative $150. and then your cash balance will go down to $1,750. So this is a cash basis. This is how a lot of businesses run it. But as you can see, there's a problem here. It looks like our profit is jumping all over the place. Sometimes we're profitable, sometimes we're not. Even though our business is a little bit steadier than that would seem to imply. Let's now account for the same series of events, but instead of doing it on a cash basis, let's do it on an accrual basis. And the whole idea with accrual accounting is to match your revenues and expenses to when you actually perform the service. So it actually captures business activity, as opposed to just capturing when cash changes hands. So let's see what that actually means. So in month 1, you cater an event, where the cost to you was $500. The customer pays you $1,200 for your services. And what I'll do the accrual accounting right here. So this is kind of the cash income statement. Let's do the accrual accounting income statement. So you actually provided the service of catering, you got $1,200 for your services. So I'll put $1,200 for revenue. And the expenses associated with that service that you provided in month 1 is $500. And so your profit is $700. So at least for month 1, the cash bossy and accrual basis of accounting look exactly the same. And once again, you have $700 in cash. Now let's go to month 2. You cater an event where the cost to you was $800. You and the customer agree that they can pay you $1,700 the next month. So now it gets interesting, because you performed the catering that month. And the catering that you performed that month is worth $1,700. So in the accrual basis of accounting, would say that you earn $1,700 of revenue, even though the customer did not pay. They did not give you the cash. And the way that you account for that is on your balance sheet you say that you are essentially owed $1,700. And then the cost to you was $800. So here, all of a sudden, you performed the service, the revenues and expenses for that service are in that month. And now your profit here shows $900. So $1,700 is accounts receivable. This is essentially stuff that other people owe you. You need to receive this from other people. But it's an asset. Other people have an obligation to you. So you have an accounts receivable of $1,700. When they pay you the $1,700, it goes from accounts receivable to cash. So it is actually a better reflection of what you did at that month. Now, the reality is that you didn't get the cash for it, and you had to spend $800 of cash out of your pocket. So you're still, just like the cash accounting, you're still going to have negative $100 in cash. Now, let's go to month 3. You get $1,700 from the customer the previous month. Now with cash basis, you would have added that to your revenue. But here we already accounted for it in the accounts receivable. We already took that revenue, but because you got the $1,700 in cash, it's going to just disappear from receivables, and then go into cash, because you actually got. You get $1,700 from the customer the previous month. You also get $300 in advance from a customer that you have to cater for the next month. So you did no catering in month 3, and because you did no catering in month 3, you have 0 revenue in Monday. And then you also have 0 expenses. The way that you account for the $1,700 that you got is that your accounts receivables goes to 0. And that goes to cash. So the negative $100, you add $1,700 and $300 to it, so it will become positive $1,900. And the WA that you account for this $300 in advance from a customer, is you call that deferred revenue. You've got the cash there. So we went from negative $100, added $1,700, making it positive $1,600. You get another $300 in cash, so that gives us $1,900 in cash again. But we didn't earn any revenue. That $300 was a kind of cash advance. So we put that right over here in deferred revenue. That's revenue that we're deferring to a future period. In the future, we will earn it. This is now a liability, because we are able to earn that revenue. And then in month 4, we actually earn the revenue. So in month 4, we can actually put it on our income statement at $300. And then we add $150 of expenses. So we have this $150 right over here. And so in month 4, we earned $150. And once again, $150 went away from our cash balance. So we still have $1,750. So whether you do the cash basis or the accrual basis, you have the same exact amount of cash.